Joining us here in studio is TD Ameritrade Network contributor Jenny Horn. Good morning to you, Jenny. And we got Harrison Sweeney, the research analyst at LikeFolio.com, joining us as well. The man, the myth, the legend. He's back again by popular demand. Jenny, let's talk some earnings, because Kevin and I always joke, and we even haven't made this joke yet today, and it's somewhat, there's some validity to it as well, that Nike, it marks the unofficial end of earnings season. And earnings season is something that we hold near and dear to our hearts here on Fast Markets. It's the genesis for a lot of our ideas and trades. And so we're always a little bit sad when it is the end of earnings season, because we got a couple weeks where we got to kind of fill that time. But we got Nike today, and we got FedEx as well.
Yeah, the good thing about the end of earnings season is it means that it's only like 2 weeks away from the bank. So I always look at, the closing is usually signals, the beginning of the next one. But Nike, like you mentioned, fourth quarter earnings today. And really, investors for Nike are looking for more than just an earnings beat. They're really looking to see how their digital demand has held up with improvements to their supply chain. And also they want to see if some of these geopolitical headwinds in China have sort of subsided. Now, analysts are expecting a profit of about 51 cents a share after Nike lost about 51 cents a share during the same quarter a year ago. So they are expecting that degree of growth there. And sales are actually expected to rise by $5 billion, so no small amount, annually to roughly $11 billion from $6 billion a year ago. Now, in March, Nike announced that they would be reviewing some of these supply chain issues, where it was addressed that they were sort of accused of some of these forced labor allegations. Now, this is what sort of prompted this widespread boycott in China, which we've seen several analysts issue reports they feel differently about. Some would say it's overblown, but actually a Morningstar report said Nike's Tmall e-commerce storefront experienced a sales decline of nearly 60% in April year over year. So that would, of course, then have a material impact. As we know, Nike is increasingly important. China is increasingly important for Nike. It went from being about 11% of its total revenue to almost 20% in just a matter of 5 years. And it's actually its fastest growing region. It's outpacing the company's top line growth by more than twofold. So China is important to Nike. Whether you believe that this sort of geopolitical issue is overblown or not, it is undoubtedly important to Nike. However, the noise on social media has focused a lot on the price action, and we've seen Nike undoubtedly being a winner of 2020, now sort of stuck in this range-bound area we're seeing on that chart. So that is what our first tweeter of the day talks about, which says, during 2020, Nike made an awesome move, almost a 150% rise. But nothing lasts forever, and after that came this huge consolidation. It is not the best scenario to trade inside here. Instead, we will wait for a breakout of the range. So I have to say, it's never not a good idea to trade. You could always use a neutral strategy, but nonetheless, Harrison, I know that with Nike comes this whole sneakerhead culture that I am, completely not in tune to, but I do know that they have their Jordan brand, which I can imagine generates a good amount of revenue, but also generates a ton of noise on Twitter. So how does really Jordan stack up to some of its competitors? I know Yeezys are cool. I seem like a grandma right now, I think.
Well, you're very correct about that. Jordan as well as Yeezy are both incredibly popular on Twitter, driven by the hype beasts, as they call themselves. That's the sneakerhead culture is very strong, and they are very intent on getting the most exclusive footwear that they can. So anytime Nike has a release of a limited edition, that will generate a ton of hype for Jordan. But in recent months, we've actually seen something of a slowdown for the Jordan brand. You can see here on this scatter plot, the x-axis there is showing the purchase intent year over year, and it's slowing down quite a bit. It's not showing anywhere near the same brand momentum as you can see over there. Crocs in the far right is still just outperforming immensely, but for comparison, there you can see Yeezy is actually generating more purchase intent mentions. That's denoted by the size of the dots on that scatter plot, but we're seeing really just kind of a slowdown across the entire footwear segment, which isn't great since that does account for about 66.6% of Nike's total revenue, according to their last report, the Nike brand. So that is not an ideal sign for them, but that is coming off of, we really did see some high levels around this time last year, especially with that stimulus check. A lot of people are going out and buying a pair of expensive sneakers. So that could be contributing to the year-over-year weakness.
So Harrison, I've got several issues on today's presentation. Number one, you tell your co-founders, Andy and Landon Swan, this Crocs data is fake news. This is bias towards Crocs by LikeFolio, and it's terrible. But actually, tell me if you think that what you're seeing in terms of the data, the popularity stays the same, but the data drop off in some of these big names. Is it because of so much demand being pushed forward during the coronavirus, and now by just, if you have 3 new pairs of shoes, you certainly don't need a 4th. Is it one of those things where all the inventory has been bought already, and this is just a natural slowdown once, during the pandemic, so much was purchased like that? Is that what we're seeing here? Because these numbers don't look so good, Harrison.
Yeah, it's hard to say for sure exactly what's causing the slowdown in demand, but that's definitely a plausible explanation, especially considering, as I said, the stimulus payment that was a large demand driver for these brands. And that, it's also contingent on just what Nike happens to be releasing at the time. So certain Jordan releases will generate a lot more buzz than others. Some are more coveted, and that really also impacts the resale market, which is booming for Jordans and Yeezys for that matter. We can see here, this chart is showing the digital specific mentions for Nike, as well as the Jordan brand is included in there. And these are mentions of people buying the shoes or just Nike products online specifically. And you can see here that uptrend just really mirrors the shift we've seen towards the direct-to-consumer portion of their business in recent quarters. And it's really starting to flatten out year over year. It's actually almost perfectly flat at the current date, but that's actually down from, it was 86% year over year only a quarter ago, and it's still up more than 90% versus the pre-COVID 2019 levels. So I think we will see them have no problem continuing their the massive year-over-year increases in their DTC business. But it'll be interesting to see going forward if the trend towards direct-to-consumer continues and if wholesale starts to pick back up with reopening going on.
Yeah, and I have to say, Harrison, Nike has this undoubtable fan loyalty where people are so crazy about Nike, and you look around on the street, it seems like everybody has a pair of Nikes. To Kevin's point, I don't really see that many people wearing Crocs, which I say thank goodness to. But the other name that has earnings today, yeah, I know, the day we're walking on the street and everyone's wearing Crocs, I'm a little bit worried. But the other big company, of course, that has earnings is FedEx, which also releases post-market. Another 2020 winner, I would say. But what's a little bit different about FedEx is that this strength is sort of continuing into this year, which Nike has not necessarily seen. Now, pricing for parcel shipping specifically remains super strong. We're also seeing the stock really having these bolstered expectations on the back of what has been a very strong year, of course, for e-commerce and shipping. And actually, Ben Lichtenstein was out there before I came on the segment saying he's never seen so many FedEx trucks in his life until the past few months. So that I have to say that demand is definitely something to be keeping in mind. Now, some might say these expectations are very high given that demand, but a Barclays analyst specifically said that guidance for Nike, or just updated guidance, will be the next catalyst for this stock to sort of break out with so much outperformance it's seen as of lately. So that brings me to our next tweet of the day, which says Barclays says it expects strong results from FedEx this week and thinks a likely resumption of favorable forward guidance could provide a share boost. Now, it was actually interesting. I went into this report that this analyst gave, and he said that basically UPS committing to lower pricing and improving their customer mix in the United States actually is a favorable tailwind for its competitor, FedEx. So then, Harrison, I really am curious how your data compares FedEx and, of course, UPS, the biggest competitors. I know they have different business models, but it's so easy to compare the two.
Yeah, we also love to compare the two. It's very, very direct comparison. And what we're really seeing, the biggest disparity between the two is that FedEx's happiness is really its Achilles heel. They have the lowest consumer happiness score of any mover of things company. That's even lower than some like Uber and Lyft. We see here on this scatter plot, it's down as far as 39% positive, which is it's one of the lowest for any company that we cover, and about 20 points lower than UPS. But what we're really keying in for this earnings report in particular is the recent slowdown in demand growth for FedEx. So it's currently pacing about 49% lower year over year. And that's based on just, once again, the outsized demand growth that we saw coming in during the pandemic when e-commerce was really starting to heat up. And we do need to take that downturn with a grain of salt because it's still showing immense strength versus the pre-COVID levels. And that is in line with FedEx's expectations that e-commerce will continue to outperform in the coming year. But we are seeing a slowdown, which has us leaning more bearish for this upcoming report. You can see here the purchase intent line there, just soaring to a new all-time high there, actually ahead of the stock price as the e-commerce picked up during the global quarantines and lockdowns. And now it's really starting to normalize a bit. So that's informing our bearish outlook for the upcoming report.
Harrison, when we're looking at this here, and let's connect the dots here a little bit between a company like Nike and FedEx, because I hear what you're saying in terms of just general demand, people talking about using FedEx going down. But if you're seeing the digital mentions of something like Nike remain high, obviously, each company's got a different relationship from a B2B standpoint with these different shippers. Do we need to look also at general trends of digital purchases? Do you have any data on that on the top of your head? I'm sure this is a trend you're watching. Is there still a lot of demand of people ordering stuff in general?
Yeah, that's interesting that you ask about that. We do track just generic e-commerce demand across the spectrum of all companies. And we are starting to see that normalize as well, in line with what we're seeing for FedEx. It's down about 13% quarter over quarter. But something to keep in mind with FedEx is the business-to-business activity that it has, which is something we can't really account for with our consumer-facing mentions. So that is, especially with regard to the happiness too, it's something that you can't put too much stock in, because as a consumer, you a lot of times don't have a lot of choice with regard to the shipping that you get. So even if you're unhappy with FedEx, you still might end up having to ship through FedEx. So business to business is really a key component and something that we can't fully account for. So that is something to keep in mind.
Yeah, I think undoubtedly the bar has been set very, very high here, Harrison, by analysts, by the street for this stock. It's up 95% from the beginning of 2020. You talked about some of these trends normalizing of certainly new adopters to the e-commerce space. I don't know who wasn't ordering stuff online before the pandemic, but there's certainly more now. And to your point about maybe this is a little bit out of our control, I think that's a strong one. But as Andy and Landon have talked about before when we've talked FedEx, consumer happiness, you start seeing this in reviews, you start having unhappy customers. On the long term, this can impact things over time, but that might be a story that remains to play out. Always a pleasure, my friend Harrison Sweeney, the research analyst at LikeFolio.com. Thanks for joining us as always. Jenny, we're going to ultimately trade both of